incredible just to see how quickly the market narrative has changed from expecting a rate cut in June now to some economists saying perhaps not at all this year. You've been in the seat that Powell is in, different country, India, but still I'm curious how you think he navigates this complicated scenario that we're in, which is hotter economy with inflation remaining much higher than expected, and at the same time, rates also staying higher, the impact that could have on consumers.
Yes, I mean, clearly what's happened is we've had three strong readings of inflation. One you can dismiss, certainly the January one, but the next two basically suggest inflation is not coming down. In fact, it's going up. And if you look at the measure that the Fed has looked at most closely, which is the super core measure of inflation, taking out housing, it's gone up at an 8.2% rate over the last 3 months. So this is something to worry about. Is inflation coming down steadily as it seemed at the end of last year, or is it having a new set of legs and moving up? So my sense is, they're going to do what they did, which is watch and wait. But, you heard, the New York Fed president talking for the first time about potentially rate hikes. I think that's still some ways away, serious talk about that. But clearly, the kind of rate cuts that were expected are off the table. Certainly in the next meeting, they have no more news on inflation or the labor markets. And it's likely they will continue pausing. But how long they will pause is now very much in question.
Tom, Professor Rajan mentioned John Williams, New York Fed president, who did just mentioned rate hikes, but he did said that's not his base case. But even the fact that he mentioned it, you saw the 2-year move to around 4.99%, which is a high for this year. You still have this notion that stocks can continue to outperform if rates stay high. How long do you think that theory will last?
Well, I think it's going to be valid as long as one of several things happens. One is that as long as the economy remains resilient and robust, and so far earnings have actually been coming in quite good. I mean, we're only sort of at the start of earnings season, but already Q1 looks good. And I think the second is that inflation, I think inflation really has a bifurcation taking place, because even as the professor cited Supercore, the reason Supercore is annualizing at 8% is auto insurance. If you took auto insurance out of Supercore, the long-term average is around 2.7, and it's actually annualizing at around 2.7% right now. So the biggest driver of inflation are the two stubborn components of auto insurance and shelter. So I don't know if Williams really wants to be raising interest rates or hiking just because auto insurance rates are high. And I think the third thing to keep in mind is that we don't really need the Fed to make, 3 cuts. I think the one risk to markets would be that the inflation is accelerating to the point where the Fed has to hike and therefore really weaken the economy. I think that's still very much a tail scenario, but that's the one, of course, that would unsettle markets the most.
Professor Rajan, how critical is China's recovery to global economic performance?
Well, it certainly is very important, right? China has been the engine of global growth for a long time, pre-pandemic. But I think it's also important for, the reflationary forces we're seeing. I mean, if you look at commodity prices, they were largely dead in the water for the last year because China wasn't performing up to expectations. As Chinese growth news is getting better, you're seeing some commodities perk up. Certainly, you're seeing copper pick up some in recent weeks. So my sense is that the deflationary effects of China, which have been substantial, especially on the goods side, may abate a little bit if Chinese growth picks up. And of course, it will also add to global demand, which is important.
A number of new developments today around big tech and the AI arms race, including Meta rolling out a whole new AI model. Deirdre Bosa here to break down those for today's Tech Check. Hi, Dee.
Tyler, there's so much news, and I'm in Miami for the Emerge conference. AI is all everyone here is talking about. There's a number of headlines today, but the big takeaway is that the race is on. This is happening faster than ever. It's more competitive than ever. Number one headline, Microsoft. It may have pole position with its OpenAI partnership from the beginning, but the regulators, they are not backing off. So raises the question, will that hurt Microsoft in this next stage of the race? Number two, Google is restructuring around AI, and it's streamlining its business to, quote, improve velocity and execution. A memo today from Sundar Pichai to staff underscores this new tone that we've been hearing from other Google executives. Point blank, it is going on the offensive. And the thing that you mentioned, Tyler, that I think is the most interesting today comes from Meta. It will be integrating its AI assistant into its family of apps. That means Facebook, Instagram, WhatsApp, Messenger. There's also a brand new landing page for its chatbot, Meta.ai. And to me, that's really symbolic of Meta jumping in this race and saying that they're going to compete with the Google, Microsoft's, Amazon on every front here. So this is just the beginning, really, Tyler.
And this initiative operates under the brand Llama. Am I correct? My son's favorite animal, by the way.
Yes, so this is its latest version of Llama, which it's really important to note here that this is an open source model. So Meta is essentially giving this away for free, right? And that's a very different strategy than what we've seen from the likes of Google and Microsoft and Amazon. They're charging typically a monthly rate for their customers, users, or enterprises to get access to these tools. Meta's model is a little different here. It's offering these chatbots for free in an effort to keep people within that ecosystem of apps. So it will continue to make money through advertising, through engagement, through visits, through clicks. But the other interesting thing about this being an open source model means that Meta may have to hire less of that really expensive AI research talent that the others are hiring. Google paying as much as $20 million over 4 years for some of this talent. By making it open source, it essentially crowdsources from a lot of the AI talent out there that wants to customize this model for their own uses, and in turn, they give that knowledge and those developments back to Meta.
So saving costs and enhancing engagement and advertising, that's the profit formula here. Deirdre, thanks very much. Go ahead.
You're not going to see this show up in earnings. That's important to note as well, Tyler. You're not going to see it show up in the same way that Microsoft has said that Copilot and its cloud units are actually leading to new spend by a company. So it is different there. This is more of a long-term play.
Meantime, Google terminating 28 employees yesterday. This after a series of protests over the company's contract to provide the Israeli government and military with cloud computing and AI services. Some also said they were protesting the, quote, harassment, intimidation, bullying, silencing and censorship of Palestinian, Arab, and Muslim Googlers. On Tuesday night, 9 Google workers were arrested on trespassing charges after staging a sit-in at the company's office in New York and Sunnyvale, California. In an email last night, a Google executive telling workers that 28 people were fired. They were found to be involved in protests that took over office space, defaced property, and impeded the work of other Googlers. Joining us right now is Jason Greer, Greer Consulting founder and president. And I'm going to start with this very question.
Yes.
Would you hire any of these folks who were fired yesterday for being involved in this protest? Meaning, was it disqualifying? I mean, we're partially asking, should have they been fired? But we're partially asking, now that they've been fired, should they have an opportunity elsewhere or not?
100%. I would hire these folks in a second because they are clearly true believers. In terms of the question, should they have been fired? Look, Google set this precedent back in 2018 when employees staged their own share of walkouts, and they said that we don't agree with the work that they're doing in Project Maven. Google shut it down. So why wouldn't they attempt to do the exact same thing today? What's the difference between 2018 and today?
Don't you think? I mean, I would make a different argument to you. I would actually say there's a big difference between 2018 and today, which is that Google has tried, I think, quite vehemently to change the culture of the company and to make it clear that these types of protests are not allowed. And so the question is, yes, if that was part of the culture then, but if you have an explicit arrangement and you're an employee of a company, there are channels with which you can protest, if you will, and have your voice heard. But having a sit-in, trespassing, defacing property and the like goes to a question about judgment. And I think that there is a question about whether you want to hire people who have that judgment or not.
If I'm looking to hire people who are willing to hold me accountable to the missions and values of our company, absolutely. Got to understand, with the average Google worker, they're not looking at the fact that we work for Google. They're looking at the fact that since we work for Google, we work for the world. The decisions that we make as a company will impact the world. But this is why I say to tech companies, especially CEOs, because I talk to them all the time, this is exactly the reason why we're seeing union organizing going through the roof in the tech industry. Because the thing that Google's facing is what many other tech companies are facing, is that they have employees who are legitimately saying or asking the question, what do we stand for? And if we determine what we stand for, what are we going to do to make sure that we continue to stand for that very thing? So what the tech industry is seeing today is exactly what manufacturing saw 60 years ago, where workers are asking the ultimate question, what do we stand for?
Jason, it's a difficult subject, and I think especially because we're in it right now, and we see what's happening in Gaza, in Israel, and people rightly have feelings about who's right in that situation. But I think if you take the specifics out of it and you just say, hey, protesting at a company when they tell you not to. If we go back to the 80s and we're talking about South Africa, right? Or if we go back a little further and we're talking about civil rights in this country, you know, can we say that people who have protested, despite a company saying that they shouldn't be hired anywhere else?
Absolutely not. I mean, I understand. You just talked about the fact that we're talking about, you know, civil rights back in the 60s. Thank God we had those folks that sat in lunch counters, because I wouldn't be here today having this conversation with you. I think what it comes down to is there has to be two sides to this. On one side, the employers have a responsibility not only to their shareholders, their responsibility to their external shareholders, their stakeholders, which are the employees. On the other side, what employees need to take a look at is, if we're going to hold our company accountable, what are the channels? And this gets back to the original question. What are the channels that we need to follow internally to make sure that we're holding the company accountable? Do we talk to our managers? Do we talk to human resources? Do we talk to the executives? Do we have to hold internal forums before we do these big, you know, sit-ins and these protests? I think ultimately what it comes down to is that in the case of Google, in the case of their employees, but I'd say this to any other company, before it becomes this huge mushroom cloud where it becomes so radioactive that we don't know where we're going, you have to start asking these questions internally and having these internal conversations, because if not, you're going to continue to have the same issues.
By the way, I don't disagree about the fact that employees should have views. I have views about all sorts of things. I have views about what my employer is doing, and there should be channels with which you can participate in a conversation. But if the company decides that they don't want to listen to you, then the question is, you can decide to work there or you can decide not to work there. It's unclear to me whether you should be able to stage a protest that potentially shuts down part of the company for some period of time, and then expect to keep your job and expect to get a job elsewhere.
Absolutely. Well, you should be able to stage a protest if that's your choice, because that's what it means to be an American. But at the same time, you've got to understand that there are consequences to your action. If you decide to hold a protest, you decide to do a staging where you're legitimately closing down offices, chances are pretty good you're going to get fired, or in the case of some of these employees, you're going to get arrested. In terms of their long-term futures on being hired, man, in the 80s, you could stage a protest in Missouri and then go work for a company in Texas because they never heard of it, right? They didn't hear anything about it, unless that company happened to know somebody that worked for the company that you did. Today, because of the internet, because of social media, those employees' chances of getting jobs elsewhere are probably slim to none, at least for the next 2 years, unfortunately, because hiring managers talk to hiring managers, in addition to the fact that the moment that I Google your name and I see that you stage a protest, I might not want you to come work for me. That's the unfortunate reality. They decided to take the chance. They took the chance. They got fired. Now they're unfortunately going to possibly deal with the consequences.
Bitcoin slump when Iran launched its attack on Israel last week, and raising some questions about the idea that investors may see crypto as a safe haven during times of global tension. Join us right now on this, the halving, and so much more. Anthony Scaramucci, Skybridge Capital founder and managing partner. Please weigh in. We saw you weighing in on Twitter over the weekend when I think a lot of folks were trying to figure out what was going on. We've seen Bitcoin fall since that weekend and effectively stay where it is, despite where equity markets are. It's trying to understand sort of these price movements.
Well, I wish I could understand the price moves myself. I think where I'm coming from is a little bit of longer term as opposed to just the week-to-week or day-to-day price movements. I think the point I'm trying to make is that Bitcoin is on an adoption curve. If you go back to Web 1, Bitcoin is sort of in the 1999 point in the spectrum. And so just imagine where we went from Web 1 to where we are today. And so my point is, you won't see this be a inflation hedge or a store of value, as other pundits are saying, until you get over a billion users. And so right now, it's going to be way more volatile than people like, and people look at it as a risk-on or risk-off trade until we get to that adoption curve. That's my point.
And given the adoption curve, what do you see right now as the upside and number, and what do you see as the downside number, call it 12 months?
Well, I mean, look, you could get shocks like wars, and you could get, God forbid, a terrorist calamity or something like that that could take Bitcoin down 10 or 15%. But I think you have a heavy bid on Bitcoin because of the demand from the ETFs and from the eventual drivers of things like the wirehouses that will enter the space, as well as the 401k market. So I don't think you have 50% downside, but you could have 10 or 15% downside just because it's still a risk-on, risk-off asset. But long-term, with the halving coming this week, Andrew, right, I think this thing trades to $170,000, possibly to $200,000. And that's consistent with where it's been over the 15 years of Bitcoin.
It's so sensitive to the starting point, though. Like what you want to say, how this behaves, or what does it typically do under different environments. I just looked at a chart yesterday. Since June 30th of last year, Bitcoin has been beat for beat with NVIDIA stock. Okay, I mean, nobody's saying it's exactly the same thing, but it sort of moves along this, hey, we're investing in this big picture future. This seems to be a way to play it. The other piece of it is, if the analogy is 1999 and Web 1.0, what was the central asset that you would have bought in 1999? Bandwidth? That's done nothing but gone down in value. Like, what's the thing you're investing in?
If you bought, okay, let's use Amazon as an example. Okay,
right.
And I think this is the point that Andrew is trying to make: is this risk on or risk off? Well, in 1999, Amazon was an emerging stock on an emerging technology, and it was quite volatile. And you lost 20 to 50% 8 times in Amazon.
You at one point lost 80%.
Yeah, that one time in March of 2020, it went down 80%. But if you held Amazon over that period of time, $10,000 is worth a little over $14 million today. And so Amazon is now trading consistently with the volatility of the overall S&P 500, and it certainly wasn't
also
doing
producing
that
cash flow
25 years ago.
I use a lot of Amazon. Okay, I don't use a lot of Bitcoin. Is that a problem at some point? And what do you expect to happen when we go through a dot-com bust type moment for the broader market? Does the feeling about Bitcoin shift?
I think if we go through a dot-com bust in the broader market in the next year or two, I think you'll have a price shock in Bitcoin consistent with a dot-com bust. However, if you're willing to hold that asset, which we are over a rolling 4-year period of time, no one has ever lost money in Bitcoin. But if you're willing to hold the asset for, let's say, 5 years, John, I think you do very, very well in the asset. It doesn't have cash flow. Gold doesn't have cash flow. But it does have cash flow in a weird way, because if you treat it like cash, cash can offer you a yield in the bank. And even though we had these problems with things like BlockFi during the crash, you could go to places like Galaxy, which is in my opinion, a tremendously undervalued asset, probably the most undervalued asset in the crypto space, and you could get yield in a borrowing agreement there. So you do have cash flow on Bitcoin if you think about it that way. And so long term, I predict people will do very well. And I think the point I was trying to make to Andrew through Twitter and here on the show is that, yeah, sure, it's 14 years old, but it's still very young in terms of the adoption.
In terms of adoption vis-a-vis the ETF, you look out your 4-year sort of time horizon, what percentage of Bitcoin effectively is owned by BlackRock on behalf of individuals versus individuals owning it themselves?
Well, it's a good question. So let's say there's 15 or 20 billion now, just using rough numbers, and the asset's got a $1.4 trillion in market capitalization. And let's say it went up 5x from that. And let's say the market capitalization didn't move, it's still less than 10% of the overall ownership of Bitcoin. So this whole notion that the ETFs are going to overly centralize Bitcoin, I don't buy. I think what the ETFs are, though, is they're a great conduit for people that are used to buying them.
Does the ETF create more price discovery? I mean, in some ways, you think it should create more price discovery, which in some
ways... Well, it obviously has, though, Andrew. Look, I mean, I think we were...
But in the initial stages, the discovery will always be about adoption, so it should go up. The question is, long term, does it create a sort of different sense of discovery? And you also have to think that the people who own Bitcoin today were always true believers, right? it was sort of a special cohort of people who sort of thought about Bitcoin in an unusual way. I don't know in the future if you have a large volume of Americans owning it through ETFs, hopefully they won't all be true believers in truth. You'd want them to all think different things about it. Well, and I don't know what that means.
Well, listen, I mean, you guys have a lot of skepticism on the Des. I think the skepticism is well-founded. I started out as a skeptic. I think what got me past being a skeptic is the notion that this is immutable. It's decentralized in a way that makes it very powerful. The network itself is scaling. And if you think about the way we treat money in our society over the last 5,000 years, Bitcoin checks all of the boxes. The only box it doesn't check is central bank manipulation, which I think it makes it way more powerful. And so at $1.4 trillion, could this trade to half the market capitalization of gold, where gold is $16 trillion today? We believe it can. We actually think it's going to go through the market capitalization of gold. And if you're making the point that the American owners in an ETF are not going to be enough to get it there, I disagree, because over time, the acceptance regulatorily is going to allow people to put it in the portfolio. A 1% position in these global portfolios takes it there.
Asking shareholders to vote again on Elon Musk's $56 billion pay package that was struck down by a Delaware judge in January. It's also hoping to move the company's incorporation from Delaware to Texas. And joining us right now is Charles Elson. He is founding director of the Weinberg Center at the University of Delaware. Good morning to you. We had a pretty fiery debate with Ann Lipton from Tulane University yesterday about exactly what may or may not happen as a result of this, and effectively whether shareholders, if they did vote, in fact, again now to put this plan back in place, that would be a legal thing to do. She seemed to suggest she thought it was not. What do you think?
I would agree with her on that one. I mean, look, they can vote on it, but the judge, in the opinion, pretty clearly says not only was the process bad, but the result, that the equity comp that they designed was effectively a gift to Mr. Musk, that there was no value received. Now, companies can give things away, money away without corporate purpose, but everyone's got to agree to it. You've got to get every shareholder, and that's not going to happen here. I mean, the idea is that having a shareholder vote of disinterested shareholders is certainly helpful in establishing something was fair. But here, she's determined that it wasn't, and that's the issue. You have to really rethink the whole package itself. So, yeah, they can vote. There'll be issues on how much was disclosed. Did they tell them everything? I'm sure that will be something the SEC will comment on. But ultimately, she found it was unfair. And that's
but
really,
see, this is the piece that I don't understand. The way I read the decision, and maybe we're reading different decisions, I understand that she did seem to think it was wasteful, but I don't believe that the wasteful element of it, if you will, was part of her quote-unquote decision, or frankly shouldn't have been. I thought what she was discussing was simply the disclosure issue, which was that she did not feel that the disclosure was proper as it related to the independence of the board and what she described as a deeply flawed process to get to that number. And effectively, by stapling that decision to this proxy, shareholders can now read her decision. They can see all of the terrible things, if you believe that they're terrible, and I'm not sure they are, but if you believe they're terrible, you can read everything, you know, everything that happened, and if you still voted in favor of this plan, why would that be a problem?
well, no, I don't think this is a waste case. In fact, I think the lower court, a previous judge said, no, this wasn't a waste case. What this really is a conflict of interest case. There are a lot of ways to approach compensation. The fact that she ordered rescission, not a revote, but rescission, and the fact, I believe it was on page 173, that she actually says that no, that this equity was an incentive to him. It was way beyond, he had enough. In fact, I filed an amicus, and that was in the amicus, which she cited. So, yeah, no, she definitely said, no, this isn't proper, and she rescinded it. That's the key to this opinion. I mean, the process was awful. There's a lot of awful processes, but the fact that she said awful process results in something that I find unfair. Now, if let's say she said, okay, bad process, but this still is, is still okay, shareholders approved it, that'd be one thing. But she said the result was unfair. And the unfairness is not necessarily the result of the negotiation. It was result effectively of what Mr. Musk asked for. And she said,
but Charles, let me ask you this then. Let me flip this whole thing around.
Yeah.
You are the board of the company and you're the shareholder of the company today. Today, you are the owner of you are the shareholder of this company, okay?
Yeah. Mm-hmm.
Elon Musk has been promised or thinks he's been promised a certain deal that he made in 2018, right? Let's just put ourselves in his shoes for a second, okay? He believes he made a deal, and then not only does he think he made the deal, he thinks that he hit all of the metrics of said deal. Now, you can decide that you believe that there was a conflict in all of that, but that's in his head, okay?
Yep.
He has not been paid, by the way. So I think at some point, forgetting about a gift, some form of compensation you would think would be due to him. It sounds like the judge would like to pay him nothing, but that also seems, that doesn't make any sense. No. You also need to, I assume, if you want Elon Musk to continue to work at Tesla or to focus on Tesla, given that he's somebody that has other opportunities in the SpaceX and the Boring Company and Neuralink and all sorts of other things. He's an unusual character and one of the great entrepreneurs of our time. If you wanted him to stay, and maybe you can argue, obviously, that he's continued to be incentivized to stay because he already has this bigger stake, what do you do as a shareholder?
I think that no one, frankly, can hold you over a barrel. Frankly, if someone says, unless you give me X, I'll blow myself up. At some point, you're going to have to say enough. Look, he had 20% of the company then. That's huge. Jeff Bezos, as I recall, he took like $1 a year. I mean, given your stake as the entrepreneur, what you get out of it is the appreciation of what you invested to begin with, which was huge. And to give him all this much more, I think was wrong. That's what she found. It didn't make any sense.
But should judges be deciding this?
Well,
should judges be deciding the amount of money and the metrics with which compensation should be paid? Is that the role of a judge? I believe the role of the judge should be around the disclosure issues. If it's not fair to shareholders and they're not given the appropriate information, I could arguably buy into that. The idea that we're now going to let judges set what is fair. I mean, how do you feel about that?
No, and this is where the opinion was very unusual. This hadn't happened before. But at some point, you have to say that something is so far out of bounds, which that in fact, it goes beyond reality. The fact is really why.
But it only went beyond reality because he went beyond reality, Charles.
Right.
But that's the piece of this. If he hadn't hit the numbers, we wouldn't be having this conversation. He went so far beyond reality. We all sat here in 2018 and said, this is absolutely bonkers. The chances of him ever hitting these numbers just is beyond the pale. And yet then he did it. And I don't mean to.
And where is the stock now? It's down quite a bit, as you know, because the reality wasn't necessarily what people thought it was. Yes.
But here's the piece of it, Charles. He's on the same ride with them, because he's not allowed to sell the shares for another 5 years, even if he gets them tomorrow.
He sold a lot of shares to buy Tesla. He's taking
No. Those were hold on, Charles. The shares that he sold were shares that were granted to him prior to 2018. He has not touched the shares that were granted to him, or in this case, they weren't really granted to him. They were put in place in this compensation package in 2018. Right. So, when people say he sold previous shares, that has nothing to do with this conversation at all.
Well, it does, because it suggests that he thinks his money was probably better somewhere else rather than in Tesla, which suggests that the growth of Tesla wasn't going to be exactly as people seem to think, because he took his assets and put it into another place, a la X, where he thought.
Do you believe every time a CEO sells shares that is a sign of what they think of the company? In some cases, in this case, he wanted to buy something, and he wanted to use the money. I actually recently talked to a CEO who, it was actually very interesting. I was talking to a CEO who I saw sold some shares, and I said, "Is this a sign about the company?" And the CEO said, "Go look at how much money I get paid in cash every year." And I went to look. They got paid $250,000 in cash. And they said, I've got bills. Like, the CEO looked at me and said, "I got bills to pay." I think in this case, Elon Musk had bills to pay.
Well, listen, sending a kid to college, putting a new thing on the house, getting a boat. But how many billions of dollars? I mean,
this is a very big. It's a digital boat, and unfortunately, the boat has holes in the boat because he's lost money on that too.